Look, if you're a financial analyst or an investor hunting for that elusive blend of real growth and reliable yield, you know exactly how rare a true diamond in the rough is, especially in the aviation sector. Today, we're diving into this explainer to unpack the hard data behind Copa Holdings, ticker symbol CPA, an incredibly compelling opportunity that completely defies conventional expectations.
So let's just go ahead and acknowledge the elephant in the room right off the bat, okay? Airlines are notoriously tough, volatile investments. Historically, they're just massively capital intensive. I mean, heavy capital expenditures usually eat up any free cash flow way before it ever has a chance to reach a shareholder dividend. Plus, they're hypersensitive to global fuel prices and macro shocks, which is exactly why most income investors just steer clear. But as we'll see today, Copa Holdings is systematically defying those odds. They've essentially engineered a business model that acts a lot more like critical cash-flowing infrastructure than your traditional highly cyclical carrier. Here's our roadmap for this explainer. 1. A rare airline outperformer. 2. The structural moat. 3. Powerful financial growth. 4. Reliable dividend performance. And 5. The analyst consensus. Section 1. A rare airline outperformer. Okay, this number is just staggering. Copa delivered a 24.6% operating margin in Q1 of 2026. They also posted a net margin of over 20%. To put that into perspective for the analysts watching, the broader airline industry average operating margin usually hovers somewhere in the low single digits, and honestly, a lot of carriers frequently dip into the negative. In aviation, hitting a double-digit margin is considered a phenomenal, best-in-class quarter. So pushing nearly 25%? That tells us this isn't just a lucky, seasonally good quarter, it's the direct result of a highly tuned, fundamentally superior operational machine. Moving right along to Section 2, the structural moat. Margins like that simply do not happen by accident, right? It really all comes down to Copa's hub of the Americas at Tocumen International Airport in Panama. This gives them massive geographic and operational advantages. First off, its sea-level location and favorable weather mean way fewer costly weather delays and optimal engine performance on takeoff. Second, it offers unmatched transit efficiency. Think about it. Passengers can connect across the Americas without the massive time drag of clearing customs or immigration in Panama. And finally, Copa runs a highly disciplined, cost-controlling single-type fleet. By sticking primarily to Boeing 737s alongside E190s, maintenance crews essentially only need 2 types of parts in their inventory. Plus, pilot scheduling is incredibly flexible, which just drastically slashes overhead compared to legacy airlines juggling 5 or 6 different aircraft types. And what happens when you have those hub efficiencies? You get a world-class passenger experience. We're talking a 91.6% on-time rate and a 99.7% flight completion factor in Q1 2026. That ranks right up there among the very best globally. When an airline actually keeps its planes in the air, avoids the tarmac, and eliminates cancellations, operational costs absolutely plummet. Crew overtime drops, passenger rebooking fees vanish, and customer retention goes through the roof. Section 3. Powerful financial growth.
Let's actually look at the sheets here, because the real impact of their operational leverage is undeniable. In Q1 of 2026, Copa generated $212.5 million in net profit. And even more impressive for those of us tracking growth, that translates to a massive 20.5% year-over-year jump in earnings per share, coming in at $5.16 per share. Oh, and by the way, they achieved this phenomenal bottom-line growth while maintaining what is essentially a fortress balance sheet. They ended the quarter with roughly $1.5 billion in total liquidity, ready to weather any unforeseen macro storms. Now, checking out the May 2026 traffic statistics, we see something analysts absolutely love. Demand, measured in revenue passenger miles, is actively outpacing their aggressive 16.3% capacity expansion. Passenger traffic actually grew by 17.0% year over year, which pushed their system load factor up to a highly efficient 88.2%. The translation here is super simple but incredibly powerful. They're aggressively adding more flights to their network, and they are filling those new seats even faster than they can add them. And this right here perfectly illustrates the core thesis. I like to call it the magic formula. Copa is successfully maintaining an incredibly lean cost profile, achieving an ex-fuel cost per available seat mile of just 5.8 cents. But at the exact same time, they're generating premium, high-yield hub-and-spoke revenue, pulling in a revenue per available seat mile of 11.8 cents. So they're operating with the unyielding cost discipline of a budget airline, but pulling in the lucrative yields of a major legacy carrier. In airline economics, executing on both sides of that equation is literally the holy grail. Section 4. Reliable dividend performance. For the income investors out there, you're gonna love this. At current valuations, Copa is rewarding shareholders with a highly attractive 4.48% dividend yield. Think about that. For a company actively demonstrating 20% year-over-year earnings growth, finding a yield approaching 4.5% presents an exceptional dual threat of growth and income. It is so rare to find a stock right now that gives you both rapid capital appreciation potential and a stable, high-yield cash payout. And let me be clear, this isn't some fluke yield. It's backed by a highly disciplined capital return strategy. Copa maintains a firm policy of paying out 40% of their net income, which currently funds a robust $1.71 quarterly dividend payout. On top of that, they're actively shrinking the float through a disciplined share repurchase program. They retired 1% of their total outstanding shares. That's $45 million worth in Q1 alone. This dual approach of dividends and buybacks signals a management team that is laser-focused on consistent shareholder return. Section 5. The Analyst Consensus and Risks. To keep things perfectly objective, let's play devil's advocate for a minute and contrast these incredible growth drivers against the actual risks highlighted by Wall Street. While the bulls rightfully point to that unmatched hub efficiency and rising travel demand across the Americas, the bears do note some very real headwinds. Geopolitically, there's the exposure to Venezuela, where Copa previously had to write off over $400 million in trapped funds due to severe currency issues. And of course, like all airlines, they face the constant, unpredictable volatility of global jet fuel prices. Fuel costs are always the wild card, and they can definitely impact those massive margins we talked about earlier. But despite those acknowledged risks, just look at the consensus from 10 major Wall Street analysts. It is overwhelmingly positive. Currently, 60% rate Copa a strong buy and 40% rated a buy. Notice what's missing? 0 analysts are recommending a hold or sell. You rarely see that kind of unified, high-conviction agreement from the professional analyst community regarding a company's future trajectory. All of that unified bullish sentiment culminates in an average 12-month price target of $165.20. That points to an 8.38% upside from the recent $152.42 close. Now, when you combine that expected capital appreciation with the nearly 4.5% dividend yield, your total expected return steps well into double-digit territory. For an asset demonstrating this much operational leverage, a total return profile like that is incredibly hard to ignore. So given their unique geographic hub advantage, budget-level expenses, premium revenue generation, and a genuinely shareholder-friendly dividend policy, you really have to ask yourself, is Copa Holdings the rare airline stock built to actually anchor a portfolio? What do you think? Does the structural moat permanently insulate them from typical airline volatility, or are the macroeconomic risks just too high for comfort? Keep digging into the data, and thanks for joining me on this explainer.